The broadcast is now starting. All attendees are in listen-only mode.
Good evening, everyone, and welcome. So brilliant. I can see that people are still logging in. My name is Adam. I will be your speaker this evening. First thing I would like to do is do a bit of a sound check. If you can hear me, just to type into the questions box. The questions box, obviously we're going to keep this as interactive as possible, so please feel free to type into that. Just doing a test to see if you can hear me before we proceed. So obviously I can see the numbers climbing, more and more people joining us, which is fantastic and great. Let's just have a look. Okay, brilliant. You can hear me. Okay, great. Now, my name is Adam from Trade with Precision, and I will be your presenter. Just a little bit about me as we go through the disclaimer, which I will in a moment. So welcome to this evening's webinar brought to you by ATFX and myself, Adam. And we're going to be talking about how to trade with pivot levels. So this presentation is going to be of great use to both beginner traders as well as traders looking to become more consistent in their results. So I just want to check, there are two disclaimers. I need to give you a moment with both before we continue onwards. And while you're reading that, I'm going to tell you a little bit about myself. My name is Adam. I am a fund trader based out of London. So tonight I'm presenting to you from Wimbledon in the UK. And when I'm not here, I'm usually based in Marbella in Spain, so I try to spend a bit more time there as the years go by. And I am a trend trader. I trade the daily timeframes with entries on the 4-hourly. I'm also so essentially that makes me a swing trader. That's the usual term that's assigned to traders who trade the daily. I trade all markets. Okay, so I don't just trade currencies. I like commodities. I'm very keen on indices. So we're going to have a look at a few of those markets tonight. We're also going to look at how pivots play a role in that. But I'm going to be throwing in a bit of personal kind of tips here and there, which may or may not be, maybe my personal opinion and not necessarily that of ATFX or Trade with Precision. So very important that you just keep that in mind. And again, okay, brilliant. Just looking, I will check the questions every now and again to make sure that I am answering them as we go. So I'm just going to give you a couple more seconds on this, and then we can actually kick off into the content. So I'm sure that that is enough time on that, and let's go through the agenda. So we're going to be talking about the what, the why, and the how of the pivot point indicator, how to install the pivot point indicator into the MT4 Desktop application, how to turn pivot point signals into potential trading opportunities. Also talk about a real-time demonstration by a full-time experienced trader assessing market conditions, momentum and reading key support resistance levels on some of the current hot markets, and of course why choose ATFX. So I'll be going through the markets, having a look at, I'll take you through some of the markets that are on my watch list, why they're on the watch list, which is really what I'd like you to take away from this. So by the end of the hour, what I'd like you to feel is some sense of how a trader goes about selecting a market to trade and what are the kind of conditions that we look for. I'm really going to be discussing the most universal ways to trade a market from a technical, analytical perspective. I'm not concerned with fundamentals when it comes to my trading because I'm going to be trading short periods, and the fundamentals can often play out over a much longer period of time. So I'm looking to be in trades for anything from a few hours to at most a few weeks. If I was going to be trading longer periods of periods, say from weeks to months or maybe even years, then I would certainly be looking at the fundamentals. But we could talk a little bit about that as we go. Okay, so a couple of questions here is why don't I trade the 15 minutes time frame and which pivot point do I use? And then of course, do I plot resistance and support levels myself? Okay, so to answer those in order, The lower time frames are a lot more volatile. There are more algorithms as well trading those levels, a lot more shorter term transactions, and so it's effectively a lot more volatile. And although I have the skill to do it, I can do it. I find it doesn't really suit my lifestyle. Essentially, for the most part, my trading takes me about half an hour to an hour a day, and all I'm really doing at that point is looking to see if the entry opportunities for the charts that are on my watch list have set up, which I'll explain to you when we get to the platform. And if they haven't, I just move on. I update any open trades that I have in terms of stop loss or potentially take profit or cancel any orders that haven't triggered. It really doesn't take me that long. There's not more than 50 charts to go through. I'm looking at the daily. It's very quick. I'll demonstrate that so that you'll understand why that's the case. The lower timeframes can be incredibly volatile and actually are not necessarily as profitable. So the daily timeframes tend to be much more profitable. Less stressful and also takes less time. So that's the general kind of consensus on it. Although on occasion, if I'm with trader friends and we want to do a bit of day trading together, we'll do it. But on the whole, I find that also lifestyle-wise, trading the higher time frames suits me a lot more. But certainly there's no doubt that the lower time frames are incredibly volatile. Now, which pivot points do I use? I am quite happy to use traditional standard pivot points. I'm not too concerned about them necessarily, I'll explain, but standard, I'm looking for out-of-the-box traditional, whether that's Woody or whichever pivot points are calculated, but usually the most traditional. I'm also going to be using moving averages, support resistance levels. Now, the other question, which is, do I plot resistance and support levels myself? Yes, I do. I will also go about explaining how I do that as well, so throw that into the mix. Most of it should be common sense trading. As a technical analyst trader, should be common sense. Okay, there are certain things, and I'll list them as well, certain things that traders, the other thing to be aware of is that most traders go along the same journey. So what often feels like a very personal experience is actually pretty universal for most traders going through that. Now, unfortunately, we don't necessarily these days, what would be the ideal way to trade would be to find ourselves on a trading floor or in a bank sitting right next to two or three experienced traders who could look over our shoulders, give us tips, make sure we don't make mistakes, show us how they're doing stuff, and so we would grow from there. Unfortunately, these days we have to generally kind of learn by ourselves in isolation, that is, or at least have access to. There's some good educational material out there as well, but have access to that. So it's just a little bit harder. It just means that a lot of traders, most people learning today, actually can make a lot of the same kinds of mistakes that, and I'm going to talk through some of those mistakes. Things that actually are universal mistakes that most traders make until they figure out why it's not a good idea. And so really, essentially, the question here then is, why don't I use shifted pivots? Well, essentially, pivots started out originally as the mean of the previous day's trading activity. That's the concept behind pivots, just the average, effectively the mean of the previous day's trading activity, and therefore that is the point at which I want to know today, is today more bullish or bearish than yesterday, and so traditional pivots make the most sense. All right, it's pretty straightforward from that perspective, and that's the reasoning behind it. So, okay, so we'll talk about this at a moment. Let's just go through the remainder of the slides, and I'll come back to that agenda, and I'll work through each of those elements. Okay, so what I want to do is wrap up the remainder of the slides, then I can relax, and we can all relax, and I can just go through the rest of the content. So just a little bit of a background behind ATFX. So it's only a couple of minutes on this, which is, first of all, ATFX are regulated by the FCA, the Financial Conduct Authority. They are an efficient, secure, easy way to use a payment portal. They are committed to providing competitive prices for their clients. Global investors most widely use trading platform MT4, okay, which we'll go and have a look at. Then bespoke customer service and trade support for all the client trading needs 24/5 days a week. So these are the contact details, which I can come back to right at the end so that you have access to those. So what I'm going to do here is just go back up to the agenda so that we can work our way through all of these details here. So for those of you who aren't familiar with pivot points, all right, so let's go across to the platform and we'll have a look at that. So we've got the platform over here, and what I have done is I've created it with a white background. That's just more in terms of a habit of mine. We're looking here pretty much at a daily, and it doesn't really matter necessarily which market we're looking at here. We're specifically looking at the Dow. If you haven't used the MT4 platform, it's a very simple platform. Okay, it's very difficult to break it because it's a very, very robust, very plain, simple platform. It's limited in terms of timeframes. These are the only timeframes that are available. But aside from that, it's pretty open source as well, so additional tools can be added. You know, there's a lot of repetition. So it's something you can learn in a few hours if you've never used the platform before. For example, here we can go ahead and create a new chart through a menu, but also there will be an icon over here, which is how to create a new chart over here, which is also the same as if I right click on an item and say new chart. So the point being, there are just multiple ways of doing it. If I right click on the chart, I can also, for example, zoom out and zoom in, but I also have the zoom out and zoom in icons over here. So it's really there's a lot of repetition throughout all of these. And one of the other additional bonuses with MT4 platform is the ability to use algorithms as well to develop your own or to add those to the platform. I'm a traditional, I use both, but I'm historically a traditional trend trader using technical analysis, and that's what we're going to be focusing on, and that is actually effectively where pivot points will come in. So the next thing that I want to do is I want to be making sure that I have access to all the markets. So by right-clicking on in my watch list here, I can have a look at, for example, symbols, and then I can go ahead and access the various symbols that are available to me. Now, I'm quite happy. I don't want to necessarily be trading obscure things where the liquidity is maybe low, but usually what is provided here will be the markets that are my personal favorites. So everything that's highlighted in gold here has been added to my watch list, and I can also add and remove them. The more items I have here, potentially that can slow down the platform, but this platform is going to be very fast on a relatively modern day laptop, meaning anything in the last 5 years, even if it's 5 years old, it'll still perform very well on this. In fact, probably very optimal on that type of platform. So there are various things I can do here. You'll see that I've got these tabs at the bottom where I can display different instruments and different time frames. So on each tab here, for example, I can change the time frame, get the data. If I need to, I can just refresh that. So I've got various ways of doing that, having a look at the data in that way. If I double click on these tabs, I can also see these laid out, and I can change them and adjust them, lay them out any way I want. So I could change the shape and list them side by side if I wish. But in this particular case, I usually like the habit of just double clicking that and viewing each one at a time. The more charts that I have open, the more it will start to use up memory. So usually what happens is it's a good idea for me to just close the platform, open it up again every few days to just refresh the memory, so to speak. So, and then in terms of how I set up my chart, I've got standard candlesticks here. So I'm using candlesticks because the reason for those, this is all for the benefit of those who are new to trading. Candlesticks are much easier to read in terms compared to, say, open, high, and OHLC candle bars, which are these ones that you're having a look at here. And so they're visually much easier to interpret. They give a lot more information in terms of the market's behavior. This is now coming from a technical analysis perspective. Then I have added a 50 standard simple moving average. So nothing too fancy, just a simple moving average, just going into this, throwing this on the chart, as well as a 20 and a 10 moving average. All right, so I usually also have a 200 moving average. All right, so I've taken it off just for the purposes of this today. I think I can go ahead and just add that in again. So let's go in and just go to indicators, trend, and just throw in the moving average. And I will just put in a 200 simple moving average. Nothing too fancy, straight out of the box. Make it slightly darker so I can see it. And there we go. So here's my moving average placed in there at the beginning. And then what I also have, so these are really there. They perform quite an important purpose. The moving averages give me a sense of the average of the longer term, medium term, and shorter term average of price. So if there's a really nice strong trend, they will give me some good information on that. So for example, here I've thrown on cable, so I've thrown on sterling against the US dollar, and this is a very good quality trend. This is optimal trading conditions. We've got a nice established trend of higher lows, higher highs, and we've got the moving averages all going in the same direction. So what the moving averages are doing here is they serve two key purposes. The one is that they tell me that the average of the longer term all the way through the medium to the shorter term average of price is all going in the same direction. So that's effectively implying that the trend is established. The second thing that they do is they frame price. Okay, they give me a sense of the equilibrium. This is an equilibrium point of price where buyers and sellers get in and out of the markets, and they therefore highlight areas where I can join a trend. So really what trend traders do, technical traders do, is we look to find a strong trend, and then we look to simply join that trend. So the analogy that I often use is surfing. If I was going to go out and surf the ocean, right, I'd go out to a particular area where it's known, where other surfers are potentially, where it's known for providing waves. Obviously, I have to be able to swim. I should have some training as to how to get on and off the surfboard. So all of that is implied. Then what I would do is look at the weather on the day. Is it so flat that there are no waves and therefore there's no point in going? Or is it so stormy and so turbulent that it's also too dangerous? So there is a range where it is definitely surfable, where there are waves that I can take advantage of. The next thing is I need to look for a set of waves. And then one of the most important aspects is I need to be able to time it. So I need to be able to join a wave, get on a wave, and then ride the wave until I choose to get off it or until it dies and the wave dies and I have to get away from it. And of course, then I have to decide how long I want to be out there on the day surfing. Do I do it for hours and hours until, obviously, if I get too tired, I could potentially hurt myself. So I need to be aware of those. That's common sense. And obviously over time, from the first day that I learn how to surf, a couple of years later, if I'm doing it on a regular basis, a lot of it's going to become muscle memory. Now, the beauty of this is that at no point did I really have to understand how the moon and the rocks and the earth around create the sets of waves. I can see other surfers doing it. I can take advantage of it. The key thing, the most important stuff, is safety, common sense, understanding that the waves come in sets, making sure that I time it correctly, getting on and getting off. It's the same with trading, looking for a strong trend, looking to find the entry opportunities to join that trend, and of course understanding that it does behave in sets and waves, and I need to be able to get off at a certain point. So an example of that would be trend-based traders are with currencies, for example. Ideally, we are looking for 3-to-1 reward to risk trading opportunities. So creating a basis here for how we go about employing pivots as well as support and resistance levels. So we're looking to find a nice trend. We're looking to wait for the market to provide us with an elegant and economic entry, a lower risk entry into that trend. And usually this occurs within the moving averages, where that's a really good point of an equilibrium. So in other words, whenever we find a really good trend, we'll often find that it interacts very well with the 10 and 20 moving averages, as an example. So we'll be looking to get in at that point. Now, we don't necessarily expect the markets to do 3-to-1 reward to risk moves. That means that on average, it will do a nice move that is about or approximately 3 times my potential risk. Okay, that's a nice ratio to have. Currencies might only do 1.5-to-1, meaning they do a very small move before retracing. And so we have to be smart about this by taking profits as we go and waiting for re-entry opportunities. So we can actually make a lot more money by waiting for price to get in again and again and again. It's actually lower risk to do that. We can also employ compounding. So what we don't try to do, which has never really proven to be successful historically, is to try to get in here and then ride it all the way up. That's not really how the market works. It's much better for us to get in, take some profit, wait for another entry, take some profit. And so the same analogy could be extended as well to be thinking of fishing. We're going out every day. We're looking to catch fish. Some days we catch nothing. Some days we get small fish. Some days we get big fish. Some days we get one fish. Some days we get many fish. But we generally need to be applying the same behavior and the same approach. So what I like personally, this is my opinion as opposed to that of TWPs or ATFXs, is I'm very much a fan of the index markets or equities or commodities. They can trend very well, and I can get some nice strong trends. But I also currencies, for example, might trend very well and then potentially not as well. So just bringing in a few, you can see here that a lot of on the 4 hourly, there's some really good trends on a lot of the GBP pairs at the moment. Aussie and Kiwi charts have also been producing some trends lately, but at the moment, since we had a bit of a flash crash earlier in the month, we can see here the markets are going largely sideways. So here's an example of a market that I would not be interested in trading. So that we start with common sense. We start with find a market that is trending. So we don't have to try to predict what the market's going to do next. We don't have to try to guess a change in direction. We're looking for something that is already moving and then looking to get onto that existing trend. We don't have to prove anything. We just have to observe something moving and then get on it. Much more common sense. What we do need to do is pay attention to where we get in and where we get out. So also we have stop losses in case anything changes, and we also make sure that we take profit. A stop loss is like a bulletproof vest or a parachute. Its sole purpose for existing is to minimize damages to our existing capital from the losing trades that we have. So we'll have both winning trades and losing trades. We're looking to find strong trends, get in, take profit. Taking profit will grow our account because a take profit exists to add to our account. Stop losses will minimize the damage from the losing trades to our account. Basically, they're there to get us out of a trend if it changes once we're in the trade. Okay, so that's really the purpose of that. So having a look, it's very important to be able to identify markets that are not worth trading compared to, say, markets that are definitely worth considering. So as we go through this, you can see a lot of the markets so far, all the Aussie charts that I've pulled up so far are going largely sideways. And so they're not on my watch list now. I will wait until they break out of the range to the upside or to the downside before I start looking for entry opportunities. So this is quite interesting. I mean, for example, here we've got Aussie Kiwi. It started to head down. It's now, compared to the previous charts we just looked at, starting to look a lot more bearish. Okay, so let me just have a look at your questions before I proceed. Okay, this is good. Thank you. So here's another question. So if I go back to cable, and so the question is on cable, would I wait for the close of a green candle to enter this? Thank you. That's a good question. So to give you a little bit of a background behind it. So really what I am also trying to do here is give a good sense of trading. So yeah, so in effect, what I'm looking for is looking for that nice little pullback into this area and then looking for an entry, potential entry signal here, which may ultimately be a bit of an indecision candle, because you'll notice that in many cases, indecision candles can occur at the top and the bottom. They don't always occur in the middle of a move. They tend to occur at the turning points. So that's one opportunity. There's a bit of an indecision candle, which might be called a spinning top or a doji. Alternatively, a nice little bullish candle. So if we just zoom in and have a look, this one is a little bit more bullish. It's a little bullish indecisive, if I really had to do that. Now, so let's cover a couple of, I mean, we have a limited amount of time and I want to give you as much value as possible. So basically every chart and every time frame and every market can only exist in one of two states at any one time. Okay, it's either trending or it's not trending. So if it's not trending, we're not interested. And if it is trending, it's either trending up or trending down. Interestingly enough, candlesticks can only exist in similar states. They can only be bullish, bearish, or indecisive. Okay, so for example, this one here is a bullish candle. It's bullish. It's clearly bullish. This one here is clearly bearish. Now, what's interesting is when you get a candle like this one here, it's more bullish than bearish simply because of the long tail underneath. It means that the bulls managed to push up. So generally speaking, we can categorize them that way. And within a healthy uptrend, bullish candles will tend to be entry opportunities for the most part. Bearish candles will tend to occur either at the top when it's becoming a bit exhausted or during that retracement period. Okay, so what we're really looking for is in a nice healthy trend, we are looking for supporting signals, and this is how we arrive at support resistance levels, pivot levels, Fibonacci levels, and so on. So pivot levels are originally derived from days of trading in the pit, and the basic idea behind them, as I said earlier, but I'll repeat it now, was to work out what was the line in the sand, which was effectively the mean of yesterday's trading. Okay, so whatever happened yesterday, what was the midpoint, if we look for the midpoint of yesterday's behavior and we put it down today so that we know roughly if the market is above or below yesterday's trading. That was the basic idea. There's some maths involved in it and there are different ways of calculating it, but in essence, the basic approach is this. Now, what's very interesting about it is that it's cause and effect. So what we do here is there's also Fibonacci, there's support resistance levels, and we don't really have to overthink why markets do what they do, by the way. So that's another thing. Let's talk a little bit about fundamentals combined with technicals. I've been trading for going on 9 years now. Sorry, because we're now in 2019, January. I have to update it. I'm always used to saying 8 years, but no, 9 years. And 4 of those, I think, nearly 5 years now, going professionally, which is to say for clients. Now, initially, I started out trying to figure it out on my own. Then I started out I did a couple of programs in London. I spent a lot of money on education. I scoured through videos, everything I could find, read all the books. And the issue wasn't per se that I wasn't getting information that wasn't useful. The problem was that I wasn't really being taught how to put that information into practical trading. The other problem that I had, and this is something that I wanted to draw to your attention, is I'm just going to bring up a notepad. So let's just go here and just bring this up, and then I'm going to show you a couple of things, the mistakes that I was making that are actually symptoms of going the wrong way. So if I do this, then I'm actually things are going the wrong way and I'm doing the wrong things. So first of all, trading only one market. Okay, so trading only one market, for example, just euro dollar, because somebody says that that's the most liquid. Now there's minimum 27 very tradable currencies, which are all the euro pairs: euro yen, euro GBP, euro Swissy, GBP, Aussie. So we've got pound Kiwi. We've got the majors. We've got so many. So there's plenty of those. So that was the one error that I made. Trading too low a time frame. Okay, so this would be something like, excuse me if there's any typos, something like 1 minute or 5 minutes. Now, these can change trends. They're incredibly volatile. It's high risk. If there's unexpected news in the market, I can hit big drawdowns very quickly. So it's quite volatile. Trading the daily and 4 hourly, suddenly things are calmer. The market behavior makes more sense. It behaves better. So trading a too low a time frame. It's also the same as, imagine if I'm learning how to drive, and on the first day, instead of learning in an empty parking lot where I've got no other traffic to worry about and I can just focus on learning how to change gears and using the indicator, I go onto the highway, a busy highway. It's just insane. It's too much information coming at me, and this is the same as trading lower time frames. So beginner traders, for their first 6 months, if I had to go back and give myself advice, it would be don't even touch the lower time frames for the first 6 months that you trade. Focus on just getting used to price action. Besides, traders have to look at higher time frames for confirmation as well. So if I'm trading the 1 minute, I have to look at the 5 minutes, the 30 minute, the 1 hour, the 4 hour, the daily, and the weekly to know where key levels are and to know what the higher time frame trend is. This is important because they tend to follow the higher time frame. Whereas if I'm trading the daily, I generally just have to look at the weekly. So it's fewer charts for me to try to figure out, and generally the behavior is not as choppy generally. So that's another one. Obviously risking too much, so not using a stop loss. Now, I know most people know this already, but it becomes also more emotional. So if I put myself in a situation, if you ever know of someone that just rubs you up the wrong way, as soon as you're around them, they just say stuff that drives you wild. And then the best thing actually is to not, if you can, not put yourself near that person, because if you're just near them, it'll just drive you wild. It's the same thing as if I get into a market where the time frame is too low and too volatile, it's going to upset me because the trades are going to be all over the place. The market can change its mind 50 times a day on the lower time frames. And so it's going to put me in a position whereby I'm going to become more emotional because it's just too loud and noisy, or just too noisy. So those are a few. The other one was using I want to say inexact tools or inexact strategies. So there's no set strategy or something like a moving average crossover, okay, which is too slow, it's too delayed. It doesn't generally yield enough profits, because out of every 10 trades we take, we're going to have somewhere between 6, maybe 5, let's call it 5 and 9 winning trades. If we have a really good winning streak, we'll have 9 winning trades out of 10 trades, and average could be anywhere from 5 to 7. In the beginning, while we're still figuring out how to read the market, we're still learning technical analysis, we're still mastering our strategy, we're going to make more mistakes because we're just beginners. We're just newbies. We're still learning how to walk. As we get better and we master our strategies, the number of mistakes we make drops exponentially. And so we just tend to have fewer losers. And so it's not just how many winners we have. Inexact. Sorry about that typo. So we've got those. There's a couple more here, but things like inexact strategies, there's a couple more here. But of course, what this does often is drives revenge trading, trading only one market, trading too low a time frame. These are things that often happen. So if I'm doing these things, I'm generally going to put myself in a place where I'm going to struggle. And so the opposite tends to be the case. Okay, now, whereas in reality, trend-based traders are trading any market that trends. They probably have a range of time frames. So if this is trending really well on the daily, which it is, okay, then I can get entries on lower time frames. So that means that when it's trending, for example, there were entry opportunities even down to the 15-minute. Let's just zoom out here a bit. But there were entry opportunities as we go back. Let me just do this so that we can see that there were also entry opportunities in a similar fashion on the lower time frames. So basically what that means is that trend-based traders, no matter what their time frame, they are likely trading the same instrument because it's moving. So that's a conceptual idea we want to get across. Pick a market that's moving in a nice, healthy fashion, and then depending on what your time frame is, you can get your entry in and out. So again, even if I was trading the 15-minute or 30-minute time frame, it would still be this chart when it's trending. But I'm looking for very clear, stable price action. All right, so then getting on to the continuing with the pivots. Let's just clear this up. Look at your questions as we go. Okay, there's some good questions here. Let me get to this. I'll make sure that I answer these as well. Okay, so first of all, the pivots. So the pivots are there as a tool, and effectively, whether we believe they work or not, we know that enough people in the city, for example, I've actually worked with city traders, older than me, is experienced, and they will use pivots because that's how they started out doing it. Some of them will use Fibonacci levels. Some will use, almost all of them use horizontal support and resistance levels because it is still about price. Despite what we think, the currency market is made up of so many different participants. Tourists exchanging money, businesses paying suppliers, people ordering stuff off Amazon, shipping, hedge funds trading, so institutions, banks transferring money, central banks holding currency. There are so many different participants in the market, so many different transactions taking place. It's an absolutely gargantuan market if we're just talking about currencies here. And so really, the reason we're talking about it tonight is because some traders, big traders with traders with big accounts might be using, and I might be referring here to a trader who's working for a bank, a central bank, or working for a hedge fund. They will use pivots for whatever reason they believe it does, and we might be using Fibonacci or whatever. Once we put it all together, what we really are going to be focusing on, and this is the part I want you to remember, we're really looking for levels that coincide with other things. So in other words, we're looking for Fibonacci levels or pivot levels that overlap with historical horizontal support and resistance levels. So the reason being that whether or not we believe they exist, we can assume safely, and certainly from experience, that the combination of all the traders in the market, the combination of all of them means that some of them will place orders where pivot levels lie, some of them will place orders where horizontal levels lie, some of them will place orders where Fibonacci levels lie, for example. And so where we find what we could call a cluster of those different elements, there are more likely to be a density or a dense collection of orders at those places. Now, and they're likely to trade in the direction of the trend. Nobody who's really experienced is looking to trade against the current. We are also little fish. We're just going to trade. We're going to follow the whales. And so we're looking for that. So that's really how pivots come into play. So the question here is, how do you determine that a trend is about to end with a candlestick pattern rather than just a pullback? Okay, so the answer to that is a couple of different things combination. We actually really don't look for a trend to end with just a candlestick. First of all, support resistance levels, horizontal levels that we see on a monthly and weekly chart, we identify those because those are areas historically where price has changed direction and is likely to change direction. It's unusual for price to change direction for the first time in the middle of nowhere. It usually will change direction at these levels. So that's the first area where we will look to see if price is going to change direction. The next thing we do is I've got two indicators here, okay, so that I use a little tool here. So this, I also need to explain this to you. So I'm using both a MACD with default settings that straight out of the box. I've changed the colors, but the settings are the same. And we've got RSI. So this is RSI at the top and MACD at the bottom. And all I've done is change the colors of them so that I can see them. I like them blue. Okay, now if you imagine that what is the most important information that I'm seeing here? Well, everything that I see on the chart, starting with price action, is the most important stuff. If I'm driving in my car, what I see through my windscreen are the other vehicles, the pedestrians, traffic lights, roundabouts, so on and so forth, stop signs. That's what I see through my windscreen. These are all things I need to be paying attention to. But if I look down at the dashboard of my car, I've got a petrol gauge or a speedometer. I've got various other tools that can assist me while I'm driving. Okay, if I absolutely had to, I could drive my car pretty well without looking down at my dashboard, for generally speaking. But I certainly couldn't drive my car safely or successfully if I couldn't see through the windscreen and I was just looking at my speedometer, my petrol gauge. So this is the most important information. These are additional tools. Now, these are momentum indicators. What does that mean? Well, essentially, and I can mix them up. I could use stochastics. I could use Williams %R. I could use a variety of different ones. I like these two. They're just relatively old. They're set in their ways. They work pretty well. They are there because they are momentum indicators. They basically measure the speed at which the market is moving. Okay, so what happens is they tell me if the market is slowing down. I might not see it. Perhaps what's happening is you'll see here it does about three green candles up, then comes back. Now it's doing, let's call this one 4 candles. Let's just say it did 7 candles for the next loop. That means that for the next move, it took much longer to do the same distance. What would happen here is these moving averages would fall behind because the market has taken longer to get where it's going. Although it has created a new high in price, it took more candles to get there, therefore more time. That could be an indication, could be that the market is losing steam. And so what happens in that case is these moving averages start to fall behind. So price is going up, but the moving average is not going up at the same speed. And that just implies that the market is potentially losing steam. Now imagine, if you will, that there was a key support resistance level up here. And so as price got up here, okay, I saw the moving average drop lower, but price went up. And it did it with a lot of little candles. And then imagine I got a very strong rejection candle against this level, something very bearish, like a strong red rejection candle of that level. So now what's happened is price has come up to a historical resistance level. It gives me a very strong rejection candle, and I've got what we call divergence on the indicators. That would tell me the probabilities of price now consolidating or changing trend are now incredibly high. So that is how we would go about doing that as traders. We wouldn't just look at price action. We would look for a collection of evidence, and then once we have it, the indication is very strong. But almost always we look for divergence around these key levels. So basically, everything comes down to, if I had to start from scratch, if you give me just price and horizontal levels, I can trade, because that's what we do. We trade when the market goes from one level to the next. But I use the moving averages because they help give me a sense of entry. I can use pivot levels as well, because if price comes back, as it does here, so let's go, it's actually difficult to see here. What I'm going to do is add a different type of pivot level in. I've got various different ones, and I'll talk to you about how we go about adding those in. If I go ahead and let's just see which ones we've got here. So I like, this one's quite interesting to me. This is just, I'll show you where I found all these various ones. And then I'll answer your questions. Let's say I actually prefer it the other way around. So what I'm going to do is change this. I'm just going to swap these around. So I want that one to be the case. I want that to be nice and thick. That's my central one. And then I'm going to change these to green so I can enjoy that. Let's just say I take lime green and just change the color of these. And then I'll explain how we do this. So basically, once I put this on, you will see now these are my pivots for the day. If I just expand this a little bit. Okay, these are my pivots. The blue one is my central pivot. So effectively, this central pivot, we are now in the 1 hour time frame. This is the average, the mean of the previous day's trading activities. Right, and you can see here, interestingly enough, the market has respected the next pivot level. So these levels here are subsequently called resistance 1, resistance 2, and they can go on. You can have as many as you want, but traditionally we use up to 3. I mean, there are 4 usually by default, but we use 3. So we call them R1, R2, R3, and at the bottom we've got support levels: support 1, support 2, support 3, or S1, S2, S3, and this is our central pivot. So you'll see that it seems to be encountering some resistance here at R1. Let's get rid of this horizontal level. So we find that it is encountering some resistance there. And this may well simply be because there are traders that are looking to sell at that level. It might also overlap with various other things. Now, what's interesting and where it gets very it catches a lot of attention for traders is if hypothetically we've got a support resistance level here. Look at this. I like this very much. We have got some resistance of price reacting multiple touches at that level. Price has come down, also tested that same level as support. What's interesting is there's also a pivot level here. So, and it's potentially near, let's say, for example, a round number of 3075 or something like that as well. Basically, what we find is then that would now have more significant meaning because that is a level. So I'm not necessarily as concerned with which pivot it is. Okay, so in other words, I'm not going to obsess that it's the central pivot or S1 or S2. I'm really looking to overlap a pivot level with a horizontal level and potentially a Fibonacci level, and maybe also have price in that buy zone or sell zone. So if we kind of go back to the 4 hour and have a look at it, zoom in, you can see price has broken through, come back, and this is often a case with a nice entry into a trend. It can often come back to the previous level, so you can see it actually happening here as well. Similar there in a nice healthy trend, it can do that quite a bit. And so price will come back. Ideally, it would come back and actually rest on the pivot near that. In the buy zone, this area between the 10 and 20 moving averages, you'd get a nice bullish candle, and potentially it would also be touching that pivot. So you would get multiple signals that buyers have placed their orders there and the market is reacting to that. Then I might look at the 2 indicators below, see that the momentum is still healthy. In other words, the MACD is still going up, which you can see here. RSI is relatively flat. And basically, I'll show you what divergence looks like. We'll look at cable on the monthly, and I'll show you that. So, having done all of that, potentially, maybe I want to throw in a Fibonacci measurement as well. So let's have a look. So then what I would do is have a look at the Fibonacci indicator, and what I could do is measure it from this low to this high. Okay, now of course the colors are all wrong, so I'm just going to go ahead and edit that, change those colors, and just make sure that we can see it. So for argument's sake, set it up, and let's just go through and remove anything that I'm not going to use. I'm not going to use this. Let's just leave it at that. So just delete these, delete that, delete that, delete that, and go. Okay, so now I have Fibonacci measurements. Actually, I want to go back and just change that color again, make it a bit darker. There we go, and make it a little bit thicker, just so they stand up. There we go. So I find that price is coming back, and there's a 50 fib level. I notice there's also a 618 level on that pivot level, as well as say a horizontal level. It's also in the buy zone, and so on. So this is what we refer to as a cluster, and this is where pivots are incredibly powerful when they overlap with horizontal levels and Fibonacci levels. The levels that I'm predominantly going to look at on a Fibonacci retracement are the 382, 50, and 618. For those of you who are not familiar with this, all we're looking to do, ladies and gents, here is take the most historical, traditional tools that traders use of old. There's plenty of traders still in their 50s, 60s, and 70s in the city. They control most of the big money because they're long in the tooth, but that's what they do. And we're looking to make sure that we are aware of all the levels where they may be placing orders. And generally speaking, if we take moving averages, horizontal levels, pivots, and Fibonacci, we can generally identify the most important levels, especially when they coincide with nice round numbers. So this one is nice because you can see that it has connected with the 382 as well as the 50. It's sitting above that 382 and the 50. We don't necessarily have to get stuck on one level. What we're looking for ideally is an area where we can look to get in. And in this case, what's happened is we've got some nice little bullish candles here. So one of the approaches that I may take is to place an entry order above the high of this bullish candle here with my stop loss below the low. If I'm a little bit cautious, I could put it a little bit more conservative. I could put it below my stop loss, below these levels. I would get additional technical protection. Why? Because I would get protection from that horizontal level plus the pivot level. And so that would just give me that little bit of additional technical protection. So it's just common sense in terms of that. Now, as I said, I've been trading this way so I've been trading about 9 years in total. I've been trading this way for nearly 5 years now. And so it's just finding that sense of, okay, I finally get what I was doing wrong. I wasn't trading. One of the other points that can go in that list was trading no matter what the conditions. This is a big one. So in other words, trading the euro every day or trading the DAX or trading the S&P, and it's just a crazy day. Some days are just not tradable. There's stormy conditions. Some days it's too flat, and maybe there's a US holiday, and so the markets don't do anything. So that's an example. So what I'm looking for is to pick a market with a nice stable trend, waiting for pullbacks where I can get in, looking to identify areas where there is a confluence of support levels in an uptrend or resistance levels in a downtrend. One more thing that I might do, some traders might measure their Fibonacci from the most recent swing low. We certainly take that into account. Other traders might go, well, if I measure it from the one before that, do I get any overlaps as well? And we often find that, especially if we do multiple measurements, we can do as many as we want, but if we do multiple measurements and we find that we get multiple overlaps, so maybe we get a 302 Fibonacci level from one measurement and maybe a 50% Fibonacci level from another measurement, we have on top of a pivot level, on top of a horizontal level, we've now just accumulated evidence as to where that support level is going to be. If the trend looks nice in the picture on the candlesticks, the indicators look happy. There's maybe no economic calendar news, or high impact news like non-farm payroll or some kind of interest rate announcement, then there is no real reason. The probabilities are that the trend will continue. Remember that professional traders are looking to get in here as well. So it becomes a self-fulfilling prophecy. We don't really care whether it is or isn't. Basically, this is how the markets will tend to move, and that's how we'll tend to do it. So let's have a look here. So I'm going through questions that I want to make sure that I show you how to add the pivot point into MetaTrader 4. Make sure that I go through everything on the I've actually covered big chunks of it already, but not necessarily in the order of the agenda. So question is, I have a problem of not using a stop loss. My question is how to effectively use the stop loss without losing money. Okay, that's a very good question as well. I'm not being false here. I'm saying those are genuinely good questions. I'll answer that as well. Do I use slow stochastics? I can. What I'm really looking for is to make sure that my focus must be primarily on price action. Everything else that I add to my chart mustn't clutter it too much. It should support the idea. So what I would like you to take away, the concept that I've pitched here is, fine, I'm looking for a nice trend. I'm looking for an entry into the trend. I'm looking in an uptrend things to find support on so the market won't go down. It shouldn't if the trend is healthy. If it's a downtrend, I'm looking for areas where there's resistance. Okay, so here's another question. Okay, so I'm going to answer all these questions, but here's the other question that's worth answering now. Where would be my target price? In other words, where would I look to take profit? So what I'm going to do, because my chart's a bit messy now, is just get rid of these items, just clean that up a bit. So where would I look to take profit? Well, let's just say that I had looked at my daily, weekly charts, and I'm going to show you support resistance levels. Let's just say that I had looked and found that there was a very significant monthly level here and nothing else really in between. Okay, so this is the way technical traders do it. Then technical traders would go, this is a nice setup. I've got some good support here. If I put my stop loss below that or below here, and I'm looking to go long, I'll be looking to take profits maybe just in this area here, potentially below that R3 or potentially, but certainly below that level. The market has the potential to go up there. The trend looks healthy. There's no reason why it shouldn't go to that. And that is the only significant support resistance level in that place. So that's how I go about doing it. I like to look and see what that potential is. However, I don't just assume the market's going to do that. In the same way that if I was surfing, the waves don't know that I exist. The waves don't care that I exist. I get on the wave, I get off the wave. Sometimes I get on a wave and it just dies. I don't take it personally. I just go back and I wait for the next wave and I get on that. It's the same way with trading. So basically, I would look to do this, and this is my personal preference, again, my very personal preference. I usually split my orders into two. So let's say, for example, I'm using 1% risk. I would use 0.5% on one order and 0.5% on the other. Both of them have the same entry and the same initial stop loss placement. Once I'm in the trade, the first trade will have a 1-to-1 target. So that means that from my entry to my stop loss, the same distance will be my first take profit, and I will take half my profits off the table. This is my personal preference. The second one will then have a take profit below the next key level, or potentially a 3-to-1 or something that is relatively realistic. With currencies, I do not expect 3-to-1 or more. I usually expect a 1.5 or 2-to-1 on those moves for the most part. Because I'm trading client funds, I'm looking to make sure that the account stays break even and adds profits. So there's very rare for me to have big losses because I'm always taking profits. So even if it just goes 1-to-1 and then comes back, my account's at break even. So, but if it hits by 1-to-1 and then goes on, any profits I make generally will show. So for example, let's say that out of 10 trades, I have 2 losing trades. Okay, fine. I get triggered in, I have 2 losing trades, so now I'm down 2%. But then out of 4 of the remaining trades, so now there's 8 trades there, 4 of them I have break even, so the account stays where it is, and then 4 of them I make 2-to-1 or 3-to-1, and then the account's up by that amount. Okay, so to give you a sense of what I'm expecting, per week, I'm looking for 2 to 5 trades per week, so you might want to write this down, 2 to 5 trades per week. I'm looking to yield about 1% profit. It's conservative. It's very conservative and quite realistic. Looking to yield about 1% that week. Ideally, by the end of the month, that will then compound to 4 to 5%. Okay, that's realistic. And then I'm looking for those in multiple markets. So the important thing that I have learned after all these years is that currencies are not enough, not just Forex. I must be looking at other markets. I must be looking at things like gold, which if you look at it on the daily, has been trending very well. Same thing, look at those moving averages fanning out. I've been trading for a bit longer, so I don't use the 200. I use just the 50, 20, and 10, but very, very nice. And I can see where those support resistance levels are. They tend to stand out, so there's some levels here. Okay, so there's some good ones here. If I go to that, support resistance, again, support resistance, okay, a lot of these things filling out here, and so on and so forth. And you can see also there was some strong resistance here. So, ladies and gents, what if I wanted to get back in here? Well, if price came back to test this level, I could potentially get in. What I would like you to notice is that here we have a fresh high in price, and you'll notice here that the RSI is actually heading down. It's actually a bit lower here, so is the MACD. This usually indicates that the market is a bit overstretched. Doesn't mean a change in direction necessarily. One of the things I would have liked to see, ladies and gents, was to see it break out and retest the weekly. It's going to have to do this is a weekly chart. It's going to have to come back to the moving averages on the weekly time frame as well. It always has to do that. Look at this one. This had a long run down, no retracements back into the moving averages, and then it just changed direction. So that can happen here as well. You can also see here, there's definitely some resistance that we're encountering up here where we are, and also again there will be more significant resistance up here. So these are the areas where I'm looking for that. If we break through this, it's fair to assume we will head all the way up there, and certainly if that's the case, that will give me some opportunity and some relatively decent trends. So I think what's likely to happen here is if gold is still bullish, we're going to go sideways for a bit potentially, and then ultimately we're going to have a breakout and head up high to that next level, and I'll be looking for multiple entries if I can to look to take profit there. And again, remember that if price happens to break through a level and comes back down, and tomorrow there's a pivot level here as well as support resistance and also potentially a Fibonacci level there, then I might find that, oh, okay, this is an area where I'm looking to get in. We're not there yet, but you can also see a nice little reaction. This is a very nice bullish candle off the 23.6. So those are areas where I'm looking to do it. But my decision, by the way, ladies and gents, is only to buy. This has got an uptrend on the weekly. All right, it's got an uptrend on the daily. Higher lows, higher highs. And the 4 hourly is also high lows, high highs. So it went through a consolidation and broke out on Friday. The point is that my direction is long. That's what I'm looking to do. So let's just go back to the slide deck. I want to make sure I've answered all these. How to install it, this is very important. I want to show you this quickly because we've got a little bit of time left, and I've explained how to turn them into trading opportunities. We've gone through the markets, looked at a few. Let's go back to that platform. So the way this works is that if we go to the file section here, there's a data folder. Okay, so we can actually add indicators that we download from the internet into a particular folder. Once I click on that, it brings me to a terminal, which is very difficult to find any other way. And then I need to go into this folder MQL. So basically anything I'm going to customize and add into my platform is going to be here. There's an experts folder if I want to do robots. There's an indicators folder. So this is really what I'm concerned with, is the indicators folder. And once I go in there, you'll see that everything that's listed here is also what's listed on the left-hand side. And so if I effectively have a pivot indicator, I can drop it into this folder. I can either restart MT4 or I can just go in here and refresh it. So I'm actually going to show you that, and I can just right click and refresh it. And then it will check if there's anything in that folder and update it. So let me just go ahead and close that and show you that process. So let's just say that I went to a website. So I was given a link. So there's a link that I might potentially want to go to. What was the, no, that was the color that I did. Let's just go and find, I had the link that was given. So this is the link for one of the indicators. Okay, there's usually one, but I can go and find different indicators in the market. So let's say I find this one and I like it, or the one that I used, different ones, and I can download that. So I would usually download that MQ4 file and put it into the folder. I'd go across to the platform, go into the open data folder, and go into the MQ. Now, it's confusing if you've never done it before, but this is about it, the extent of how confusing it is. Honestly, MT4 is a very simple program, and there's only so many things you can do. And I would then copy it into this folder, either restart MT4 or refresh this indicator, and then subsequently it shows up. So I've actually got a couple here. I've got pivot points that I can bring in. This is daily shifted. So there is the daily shifted one. These are the colors. Let's just say that I want to highlight. I want to get the blue that I liked so much, and I want to make it nice and thick. So then I can throw that on, and you can see it's starting to show up in the chart. So let's go down to my lower time frames. There we go. And I will remove this indicator. So I've also got these ones that are shifted. So basically the shifted ones are showing me the previous series of days. I find that I really want to focus, remember that I want to start with horizontal levels. That's the most important stuff. Start with horizontal levels, and then I want to know what are tomorrow's pivots or today's pivots, and that's where my focus is. For me, and this is my personal opinion, not that necessary of ATFXs or TWPs. Having all of these in the past is nice if they overlap, but I don't want to clutter my chart with, I don't want to suffer from analysis paralysis, which means I'm now trying to find all these different things. Basically, I'm looking to see if there's a key level I need to be paying attention to, then looking to see if there's a Fibonacci level as well as a pivot level that overlaps with that. So that's one indicator there as well. That's there. I've also got pivot points all in one, which is quite cool. Let's have a look at that. So these are just different ones. Very hard to see this. So I'll go into the indicators and just make it a lot thicker. Pivot points all in one, and we're close. We're actually good for time. We're also looking very good. Here's the line width, so let's do this nice and thick so everyone can see it. And there we go. So these are my levels. So these are just different ones. All I did, ladies and gents, was a Google search, MT4 pivot points indicators or something, and then I just took the first three that came up. So there's different ones. This gives me today's one. That's quite cool. And then I've also got other ones here. This is interesting because these pivot points here are close to this level. So, and this one is close to this level. So that is significant to me based off today's trading. It makes sense if price was going to be drawn to that, because don't forget there are sellers, technical traders, who will sell down to that level as well. You get bears and bulls in every market. So that really is how we go about installing it into the desktop, how we go about using it, turning those signals, especially price action's reaction to those levels. I'm looking at an uptrend for bullish reactions off those levels. And the last thing that I would do, we've got 2 minutes, is show you the support resistance levels. So let's say that I go to a chart, and I'm just going to just temporarily remove this and the pivot points all in one, just get rid of that, and start to look at these for important levels. So let's say, for example, we've got the euro dollar here. It's fine. Oh, I wanted to show you divergence. So we'll go and look at cable. Let's go look at this on a monthly basis. It was actually weekly that I wanted to show you. So there is something I wanted to show you here. This turned out to be a very significant horizontal level. And all I wanted to show you here was that you can see how price reacted against it. The next time it came up, we got this very bearish reaction there. It's a very strong reaction on that weekly time frame. And this was a predefined historical level. What's interesting is when you then look and compare it to the indicators at the bottom, these indicators which we refer to now as divergence, you'll see now that although we got a slightly higher high on that candle there at that level, we got a lower high on this indicator. And so that really tells us that the momentum of the market is not happy. And that means that we're either going to get a consolidation up ahead or a change in trend. In this case, it resulted in a change in trend. The reason it did was because it was so overextended on the monthly up here, it hadn't actually come back down to the moving averages. So it had just run and run and run for a year without a proper retracement. And so if it runs too long without taking a breather, it's usually going to just change direction, which is what happened with gold. When we went to gold, remember, you'll see if we looked at gold, we got that long run down on that period, long run down without a breather being coming in, breathing out, and then it just changed direction. So if we go back to this, the other thing I wanted to show you is why it's relevant, because you may be wondering what's going on with the markets. So let's look at the Dow, the US Dow. We look at this on a weekly time frame, for example, or even a monthly time frame. And you'll see here that we've got a very similar situation. I'm going to leave you with this as we go, as we shut down for this evening. But if you look here, we've got a very similar situation to cable. We've got price coming up, strong bearish rejection candle, and that divergence. Okay, on this. This is on a monthly on the US indices. And now, the difference is between a currency and an index is that over time, historically, the stock markets always climb. They always have. All right, anything can happen for the first time, but historically they always climb. So we know that in the future, whether it's 5 years in the future, whatever, the market will ultimately continue on upwards. But this is implying that it is now becoming exhausted and wants to either consolidate or take a breather. That's technically what it's providing. The only problem is this is a monthly chart. So it's going to take 10 or 12 candles for us to, basically 2019, we're going to have to see how this ultimately recovers. So this implies that the market is either going to bob around for a bit or take a bit of a breather. Maybe what it will do is come down to a previous level of support resistance, come back down, do a correction, which is normal. It always does that. In the past, it's always done it. So maybe a bigger pullback and then resume its trend potentially, or alternatively, bob around before ultimately breaking higher like we had here. We had this from 2015 to 2016. We basically had this sideways motion and then it broke out. So we might just find it's the same here and then we break out there. And basically, how will we know that? If we find the price comes back up to this level and this is returned back up, then basically it's saying, okay, I've had a breather, I'm fine, because you could just see it just ran without coming back to get to that point of equilibrium. So I just thought you'd find that very interesting. And of course, there are support resistance levels here. These are potential buying opportunities, but not for day traders per se, not for swing traders or day traders, but potentially for investors. So there's also lots of bulls sitting at these levels. And we will have corrections over time, but also we're still, certainly on a quarterly basis, we're still in a bull market. So it's just exercising a lot of caution here. Some of the currencies I've shown you are looking really nice and strong. Some of the commodities as well. So there we go, ladies and gents. We've run over by 3 minutes. I apologize for that. I'm just going to go to that last slide so you can get those contact details, and we can take it from there. But I've thrown a lot of information at you. I really wanted you to get a sense of what it's like for technical traders, what we look for, that trading is common sense. There's a technique to it. We understand what the market's doing. We're only participating in markets that have a clear direction. We're not getting involved in anything else. We don't really need to know why they're moving, because once you basically decide you're just going to trade whatever's moving, then your decision, your explanation for why it's moving doesn't really matter. I can look at a chart and go, okay, it's bullish, bearish, or indecisive if I need to. But really what I'm focusing on to actually put my money on will be something that's either trending down or trending up. So I wanted to give you a sense of that. And then indicate also where I potentially look to take profits, how I would go about using pivot levels and horizontal levels, moving averages, Fibonacci levels to support those trade ideas. And so I do hope that that came across to you and made sense to you. And I also hope that you've enjoyed this presentation. There's a lot of names there. Usually I do a scan of the names, and if I see you in any of the future presentations, I will say hello. But I do want to say that if you do attend any of the future webinars where we do market analysis or we cover another topic, which is usually myself, I do market analysis as well. I work from home. Occasionally I go into the city, but I can get cabin fever. So it can get very lonely working for about half an hour to an hour a day and not seeing any other human beings for the rest of your day. So usually that means I'm out and about. So I do like the fact that I get to do some interactions like I did tonight. And there were some really good questions. So I want to say thank you very much. I think I answered every single one. Oh, the stop loss was just explaining to you that I use stop losses by using technical levels to place my stop loss so that it doesn't get hit. That's usually that was the answer to the question. It's usually about putting it in the right place on the chart where price will encounter some resistance. There we go, ladies and gents. I want to say thank you for your time. I'm going to end the webinar, which is going to finish it for all of us. I did enjoy it. I got to say, I love it. I love interacting and I love explaining how we go about doing stuff. It's actually fun. And believe it or not, I don't talk to a lot of people, so I do enjoy it. So thank you very much for your time. I want you to enjoy your evening And there's a question here if anyone's interested. Hedging, my view on hedging. Hedging is, I'm a trend-based trader. So if I'm hedging, something's gone wrong, generally speaking. That's all I mean by that, because I trade trends all the time. Hedging is not something I would usually do. I'm not judging it. I'm just saying it's not in my life that often. Cool. All right, guys and girls, ladies and gents, thank you very much. Have a good evening. I'm going to end the webinar now, so thank you. All right, take care.